Hello, everybody. Welcome to Sunday. This is where I answer the top questions from the community, and we cover everything that is on your mind. So let's jump in as usual. A lot of ground to cover, 45 slides, and hope the audio is good. I'm trying to get as close as I can to the mic. So let's go. Let's jump in. And of course, this is edutainment, not financial advice. Never financial advice. So the first question, this is a cool one from Coding Monkey. Is the 4-year cycle in play? Where will we have an accumulation phase for 2022, 2023? Or will the crypto markets go risk on again when the Fed pivots? This is, I don't want to patronize you, a brilliant question. So big thank you for that. And it made me think a lot. So let's go back in history. Let's talk about the previous cycles and the common patterns we've had so far. So first of all, the bear markets in previous cycles have been 1 year. There's always been a reversal pattern. Then there's a 50% decline from the peak. Then there's a dead cat bounce, whatever they call it, rebound back 20% from the peak. And then there's another decline to 70% from the peak. We've hit the first 5 of these this time around. And the question is this time, will we bottom out at 85% from the peak? That is the $1 million question. And in fact, just as I started streaming, Bitcoin shot through 20,000, hit 20,400. Now it's gone back down under 20,000. But at least looking at some of the numbers and some of the buy walls, the buyers are back, which is good. Sundays are volatile. We saw that yesterday. So let's look at the cycles and break down exactly where we are. Now, here is the history of Bitcoin going all the way back to 2012. Now, you see the green box, typically a year in duration. That's the bull market phase. And we got 1, 2, 3 of those. And then we have the little red box. Again, 1 year in duration. I added some arrows there. That is the bear market. Remember that term, 1 year. And then I put in a little green cross to try symbolize recovery phase, because that is your question. Are we in this recovery phase? So right now, there are a few differences. First of all, we never got a blow off top, and that fooled everybody into thinking we are still waiting for the bull market Godot, if anybody knows that story. Now, the derivative markets, we believe, scalped the top off the bull market. So it prevented it from having that blow off top. Second, the bear has not filled the red box so far. You can see in previous cycles it went to the bottom. We don't necessarily know where this bottom is. Maybe the box is a little shorter. We'll see. Again, this is on the log scale as well. So it can be a little bit deceptive in how you visualize that red box. And third, it's nearly a year. So you could argue we are in a bear market since June, July 2021, when we had the first rip down after the high on April 14th, 2021. And then the repeated high back on November 13th. I can't remember the exact date. But anyway, or do we have, the other question I think is, do we have a lengthening cycle? So, but right now, I think the big question is, there are a ton of macro forces in play that are driving the bus here. Combined with the capitulations, the deleveraging events we saw, they've taken a huge toll on Bitcoin. So the question is, what's going to happen next? When does the recovery begin? It's really, really hard to say. Now, this is when I do believe it could be blue box time. So reminder, blue box recovery phase. I just coined that right now. So if the Fed will pivot, when this happens is determined by how much damage they want to reap on the economy. Right now, we are in a recession. Right now, they know that. They've got to know that. So right now, any more jacks that they do are just going to increase the damage to the economy. And that's not what they want to do in an election year or to the people of the United States. And once they do it, and what I mean by do it is the pivot going from hawkish to dovish, then it'll be risk on. And everybody's saying the thing that'll rocket first will be Bitcoin. And that's why Samson Mao and a couple of others, Adam Back, believe 100,000 is possible this year. Not slinging hopium, just their words. Now, the big concern that I have is QT. That's quantitative tightening. The tightening, it's taking 2 trillion out of the money system. That is a concern. And we've never seen what happens to Bitcoin during a QT environment. Again, sucking money out, 2 trillion is substantial, and that could have an impact on markets, etc. So that is blue box time. Again, very hard to say. I do have a theory, I've spoken out it greatly, that I do believe the Fed will pivot, and we'll talk more about interest rates in a second too. In this question from Blue Tiger, Bitcoin was created and has existed in near zero interest rate conditions since 2008. Can it survive and prosper in high interest rate conditions? Well, if you're old enough like me, like typically most bull markets happened, like from traditional equity point of view, in high interest, much higher interest rates environment that we have now, like the tune of 6, 7, sometimes even 8%. So that can happen. But let's dig in and talk about this for a second. So first of all, Bitcoin survival and prosperity is a function of Metcalfe's law, how much it is adopted, how many new users there are, how much is transferred through the chain, the ease of use improvements, and other advancements. Also, when you think about this question, high interest rate environment, we are still historically at very, very low interest rates. And when you actually pull out inflation, less the actual Fed funds rate or interest rate today, you will see it's very, very negative. So it is technically, from a math perspective, a negative real interest rate of about 6.85%. So that is using official numbers, of course, we can't trust. And this is the big issue here, the debt clock. We've spoken about this before. We can't go back to high interest rates is our thesis because we have too much debt. Debt to GDP is just shy of 130%. Tipping point is 77%. Again, you heard me talk about. So even, just imagine for a second, current national debt is around 30.5 trillion. Not counting entitlements, which are unfunded, by the way. Therefore, they have to continue printing money at some stage, sooner or later. But if they did go back to like a 6% interest rate or something, that would add another $2 trillion to the deficit. Coincidentally, that's the equivalent to the amount of money that they're planning to QT out of the system. Again, the math doesn't add up. So we'll see where this goes. It's like a macroeconomist's dream to see all of this unraveling before our eyes. So let's do one quick reminder as well. This is from Statista. This is the debt to GDP ratio over time. Now, again, we hit 134 in 2020, 132.63 in 2021. Remember, with inflation, that also inflates GDP. So GDP has actually gone up despite the fact there's no growth. Think about that little riddle in your head. But if you look at the overall trend, the debt to GDP ratio will go up over time. And these are very, very conservative numbers from Statista, up to 127% to 2027. You're not going to see this going down because it's mathematically not possible. So the days of high interest rates are gone. I do believe the Fed is shocking the system to destroy demand, to bring inflation down artificially. And it's working. It's working very fast. So from that perspective, I do believe they will pivot and it'll be sooner than most people expect. Great question. Next question is from JWeb. Can you discuss what you look for in traditional metrics such as PE, Sharpe, future PE, PEG ratio, etc.? Great question. So Jay, as you know, from our mining analysis videos, we like to look at tons and tons of ratios. And then we create ratios on ratios, which is a lot of fun. But let's just talk about some of the ones you mentioned here because it will take too long to go into all the detail. And let's use Tesla as a test. So quick reminder, everybody, the PE ratio is price to earnings. You take the price of stock. Tesla is trading at $650 right now. The earnings is $12.49 a share. And you get the PE by dividing 650 divided by 12.49, and you get 52.42. Now, the future PE ratio is how much you expect they will earn next year. So I reckon it's going to be about $20 a share, probably a lot higher. But again, it's sandbagged. And that's barring any perpetual lockdowns in China because of C-19. And if you take that 650, you divide that by 20, you get a PE of 32. Now, historically, when you look at traditional companies, kind of low growth companies, a PE of 20 is considered reasonable. But the wild card here is Tesla. Look at the growth rate. Earnings growth is growing at 61%. Remember that number. It's very important for the next ratio we're going to calculate, and that is PEG ratio. So the PEG ratio You take the PE ratio, 52, earnings growth, 61, and you get your PEG of 0.858. It's that simple. Now, a PEG typically under 1 is excellent. So Tesla has a fantastic PEG ratio. But if you go to any traditional finance sites and you look up what they have posted as a PEG ratio for Tesla, the numbers are like sometimes 2, sometimes 8.8. They're all over the place because they don't do the math correctly. So that is the PEG ratio and is very, very important. But let's look at the Sharpe ratio, another question you had. Now this shows, the Sharpe ratio shows a asset or a portfolio's excess returns based on a benchmark. For example, here in this chart, the orange line is the S&P 500 and the blue line is Tesla. And you can see right now, the Sharpe ratio does change over time, depending on how good it is doing. Right now, it's currently 0.07. Obviously, between 0 and 1 is considered suboptimal. But that's where we are today. But if you look at history, we had a Sharpe of up to 11.5 times back in middle of 2021, and that is stunning. Huge returns based on benchmarks compared to the S&P 500. Now let's take this Sharpe discussion and pivot it to crypto, because this got me thinking, wow, what are the Sharpe ratios for the top layer ones? SCPs, as I call them, smart contract platforms. So here, what I've done is pulled in all the data from all the prices today. Avalanche, Near, Solana, Tron, Phantom, BNB, Cosmos, Ethereum, Tezos, Harmony, Polkadot, Cardano, Algorand, Polygon, and Flow. And obviously the market cap price is all there. But what's interesting is the 1 year change, the change over the last 365 days, number one, important to look at. And also the change over the last 1 year versus Bitcoin. Imagine you're not using the dollar as the denominator, using Bitcoin. That is a very interesting story. And then the change versus Ethereum. So somebody asked, I think last week, at what stage do we need to start thinking about things in terms of Bitcoin? Well, here we are. This is what we're doing right now. Now, if you look at the Sharpe ratio on the right, you can see the winner. Let me try to pull this up. The winner with the best Sharpe ratio is actually Near Protocol at 0.83. Number 2 is Avalanche. And number 3 is Phantom, 0.64. So that's very interesting. But if you look at the returns again versus Bitcoin, Avalanche is up 106% against Bitcoin over the last year. Near Protocol 100%, Solana 68.8%, and versus Ethereum 133%, 126%, and 90%. So that's a very good way to kind of figure out exactly where things are going. I also threw in some inflation numbers there as well because that's interesting. Now let's look at this visually and try to get a better feel for how these things pan out, because it is important. You will see the correlation between Sharpe and actual performance. So on the right axis, I have the Sharpe ratio to pull it out, and on the left, I have percentage changes. Percentage change against Bitcoin, percentage change against Ethereum, and of course, the inflation ratio, so you can see how things are related. But when you draw a trend line for the Sharpe ratio, it maps directly to the performance of these assets against Bitcoin and Ethereum. Basically, the better the Sharpe, the better the performance. Real simple. Now, one last step is pulling them out and getting a visual. Again, visual price change against Bitcoin and the Sharpe on the same chart, so it's not too much of an eye chart. You can see here, Avalanche, Near, and Phantom still come out the top, while at the bottom, Flow, Cardano, and Ethereum come out worst. And Ethereum has been smashed of late. Therefore, measuring something against Ethereum has not been good, but even measuring against Bitcoin has also been good too. So we'll see. And both Ethereum and Bitcoin have done badly. Therefore, the change versus Bitcoin is actually very small for Ethereum. So again, just some fun with numbers, fun with charts, but some people aren't believers in Sharpe. I think it's a very good tool. I always look at it. Remember, the further you are out the risk curve, the more expected return you should get. And nothing has been more apparent over the last couple of weeks. Next question is from Jabba. Hey, Jabba, great question. Since Amazon had a split, is it worth it to get involved, or should I stick with MicroStrategy and Tesla? This is not as easy a question as you'd imagine, because there's a lot of dimensions to Amazon. Let's talk about a couple of them real quick. The question is, we are going into a recession, or we are in a recession. Is a retailer recession proof? So let's talk about that. Recessions do hurt retail, but even in a mild recession, you can see that people still need to shop. The question is, where do they buy? Also, this is going to be a weird theory, but I do believe we had a huge spike in business for Amazon with C19 because people were locked down. Now, gas is so expensive. It's expensive to drive 20 miles to the store to get whatever you need. Maybe that will help support the continued growth of Amazon going forward. Also, Amazon Web Services is extremely durable and growing like a weed. Everything runs on AWS. And at about 1.6 times forward sales and 40 times forward EP estimates, Amazon is relatively cheap again, considering the growth. Again, remember the Tesla growth ratio, PEG ratio? Your homework, everybody, is do the calculation for the PEG ratio for Amazon. Drop it in the comment below. I will check all your work. Just do hashtag Amazon so I can find it easy. So Amazon's doing a couple of things. They're expanding globally. They've been doubling down on overseas expansion in recent years. And it opened marketplaces in places like Egypt and Poland. They launched in Saudi Arabia, Sweden, Netherlands, etc. And they've even invested about $7 billion in India so far. And they're expanding into more countries. But expansion is expensive. They're curling back the expansion in the United States with warehouses and delivery trucks and everything else, subleasing space. But they are investing heavily overseas. Now, that comes at a cost. Now, there's a double-edged sword to this. Not only is it expensive to grow internationally, but with a strong dollar, the money they're earning overseas is less. Okay? So imagine they're selling something for 120 euros. They were getting 100 euros in Europe. They were getting $120 a few months ago. Now they're only getting $100. So launching in these emerging markets is costly. Also, the margins are tight because as they launch, they want to be ultra competitive. So I think their international profit margins are around 5% compared to 25% in the US and the UK and Japan. And I think it's also one of the biggest cost generators because it costs 1.3 billion or something to grow, expand internationally in the first quarter. So think about that. Now, there is a little bit of good news. So first of all, you heard me talk about the pre-split run, the post-split dip. Well, here we are, a perfect illustration of that, Jabba. The post-split run, like clockwork, we shot up. Remember the prices? We had a 24 stock split. The stock was trading at about 2,000, shot all the way up to nearly 2,500, and now we're in the post-split dip. But do not despair. It's not that bad. Despite their launching in emerging markets and everything else, they still have a very profitable business, massive growth, extreme profitability coming. And I believe they'll be able to weather the recession. But two things. I think there'll be a few unknowns for the next quarter or two. So don't expect it to go back up to $200 a share anytime soon, or $150. So we may have to wait a while. But the other good news, if you look at this, I added the 200-week moving average on the chart. You can see that we are down around the 200-week moving average. Historically, this has been a bottom level for Amazon. So bottom price to buy, yes. Don't expect things to be gangbusters until we find out we're in a recession. And then the markets will want to see how Amazon is performing in that recession. And that'll take 1 or 2 quarters. So hang tight. Great question. Next question. This is, what about Celsius? Could it cause another Luna type event if they declare bankruptcy? From Chris G. Yes, so I've talked a bit about Celsius yesterday and a few days ago. This is some very provisional math. It's hard to decipher exactly everything because the market is moving so fast. Prices are moving so fast. But before the downturn, I think Celsius had about $11 billion in assets. Now, of course, it's going to be a lot lower because, Bitcoin and everything is like 70% off its highs, etc. They do have 1.7 million customers. That, the rough calculation, is about $6,400 per customer in assets before the downturn. Obviously, with the dip in prices, we'll see. Now, coincidentally, there's a lot of talk of Nexo making an offer. They have 12 billion in assets and 1.5 million users. So the two companies are very similar in size in terms of number of users, 1.7 versus 1.5, and 12 billion versus 11 billion. But think of that number. So if we think of the actual amount now, it's probably a lot less than 5 billion, I reckon. It's hard to actually estimate, but I'd imagine that is the case. Luna was a $60 billion blow up, where $60 billion was evaporated in a very short window of time. This is a 12th of the size. Now, the other issue, and not just spreading all good news, but there is the contagion issue. There's been a couple of other lending platforms that have kind of stopped for fear of an equivalent type of bank run, speculative attack, etc. by other players. So watch out for the contagion. Looking at the markets right now, with Bitcoin back above 20,000 after the big dip yesterday, looks like, we don't know, I still think there's more woods to get through, but are we going to go down to the liquidation level of 13,500? I don't think so. Now, this is a cool illustration from catscatscode. Hope I got that right. They actually worked tirelessly. I was looking for this I was trying to do it myself. And it's just so hard to look at all the different wallets and try to find out exactly how much is in all of these wallets and what is in these wallets. But here you can see this is the top Celsius holdings as of June 15th. And again, a bit of a downturn since then, but you can see that these wallets alone, and they do not constitute all wallets that I know of, or other holdings that they have, just shy of $2 billion. So again, if you think of the math, 11 billion, 70% haircut. So there is stuff in wallets out there, which means a lot of people are talking about, well, even the detractors of Celsius are saying, yeah, well, investors might lose they might get back between 50 and 80% of their original holdings. So fingers crossed, anything will be good. A lot of people do not despair. There's money in those wallets. So fingers crossed they haven't done anything too crazy. So next question is Atleen. If moving Bitcoin to a cold storage wallet is the safest place, how can we trust moving it onto an exchange in the future to sell it, etc.? Is there a chance that exchanges may not have the money to pay out the customer when it is worth more years from now? Very good question. And I love the way people are thinking about all these dimensions and thinking about risk and safety, because you're thinking about the right things. So let's look at, can an exchange run out of money? The short answer is no. Exchanges are simply a place where buyers and sellers are matched up and they trade. So when you sell, you are selling to another buyer. So if you are moving your Bitcoin onto an exchange to sell, you can actually very quickly look at the liquidity, look at the buy walls, the sell walls, the amount of volume, etc. It's all very transparent, so you should have no fear. And again, in light of risk management lately, it's a very, very low risk to move Bitcoin onto an exchange or any other crypto to sell it. But make sure the exchange is reputable and liquid, and it should be very low risk. But do not, I've always said this, do not keep a lot of crypto on an exchange. Back in, when I started this in January 2021, I thought like 250,000 was the threshold. Now it's like about 50,000 or less. So anyway, with that, just don't keep all your eggs in one basket. Never put more than 10% one place or another, and be careful of unregulated exchanges. So hope that helps. Next question from Daniel M. Another Celsius versus Nexo question. I'd like to know more about Celsius versus Nexo. Nexo appears to be safer than Celsius and even made an offer. Yeah, I read the terms of the term sheet. I think it expires tomorrow on the 20th, if I can remember. So I'm not sure what's going on. The irony is Celsius are talking to Citibank to advise them. Who knows what Citibank will do. Anyway, is Nexo safer than Celsius? So obviously, Celsius is very clear they were subject to an attack. Whether warranted or not remains to be seen. C5 platforms are definitely risky. I did talk about that Nexo having 12 billion in assets. That's also before the downturn, by the way. 1.5 million users. Their lending rates are 8 to 10%, and borrowing about 6%. They have 24/7 support, yada yada. They have 375 million in insurance. I haven't dug in too much into the insurance of that at all. And they do have a longer track record than Celsius. This is an interesting thing when you dig into it. They were a different company. I think it was called Credissimo back in 2007. And they rebranded to Nexo, I think in 2018, if I'm not mistaken. And again, they also have their own token, which is basically a security and actually pays you dividends, which means obviously US persons cannot access it. So with that, I think they also work with BitGo, and they provide custodial support for BitGo and Ledger, if I'm not mistaken. So at this stage of the game, again, never put more than 10% of your assets in any one platform, and make sure you get return that is warranted, like more than 5%. Otherwise, it's definitely not worth the risk. So, will they work with Celsius? I think we would have heard something. I think if you bring on a Citibank, they're going to want to do their own thing. They're not going to want to straight exit to Nexo. I was hoping they'd have Nexo just pick them up and just work everything out for the actual Celsians, but that may not be the case. In fact, it looks very probable it's not. So next question from Captain 89. Is holding WBTC, which is wrapped Bitcoin, 100% equal to holding BTC, and why so? Sorry, just drinking some caffeinated beverage. So let's talk about wrapped Bitcoin. Absolutely not. Holding wrapped Bitcoin is not 100% the same as holding Bitcoin. Just like stable coins, they are designed to be pegged to the dollar. These things are pegged to Bitcoin. And whatever they are, if there's anything wrapped, it's typically pegged to what that asset is. But the problem is, just like stable coins, wrapped assets can also depeg. Just like the staked ETH right now, we're seeing that depegging happening. The depegging of everything is all over the place. Now, wrapped Bitcoin are just as susceptible to this very, very real risk. And some of the reasons that they can depeg, one is the underlying asset is lost or hacked. Literally, individuals lose their keys. Corporations can lose keys as well to assets. We saw that with staked ETH operators actually lost the keys to the backed Ethereum, and the asset becomes too levered. We saw this with multiple DeFi protocols deleveraging and the carnage that brings about. And the asset is unusable to sustain an arbitrage attack. We saw this with Luna, where the ARB attack knocked the algorithm off the peg and caused the death spiral. So if you are relying on the security of a layer 1 platform that your wrapped token lives on, and no matter what your layer 1 token is wrapped, there's no guarantee to be less secure than Bitcoin's own security. So from that perspective, be very careful. And again, great question. Let's go. Next question from Sob14. Say China invades Taiwan. What is the probability that the USA and West will start to impose sanctions on China? I feel like this could cripple the global economy. We have a slightly different perspective here. That's way worse than sanctions. Got some good news and bad news. So first of all, if there is such a scenario, if China invades Taiwan, the US is not going to impose sanctions. It's going to go to war. Biden said that multiple times. He rattled China back in April and May when he came out with that. But remember, Taiwan is not Ukraine, and the US has not committed to defend Ukraine. I think they're sharing some weapons. That's about it. And there's no strategic reliance on Ukraine. However, Taiwan is a total different kettle of fish. The US will absolutely put boots in the ground or planes in the air or whatever, boats in the water to protect. And the concern is this could trigger a World War III, and such a conflict could actually also be nuclear. So that is not good. Now, there's a couple of good things, though, again, as we mentioned. First of all, China is not Russia. There is no troop buildup. China is more connected to the global economy, and invading would be crippling itself. The nuclear war, would put mankind's existence in jeopardy. And we believe the scenario is extremely remote. Also, if you think about China, they play the long game. They don't need to go to war or take over Taiwan to dominate the world. They're going to do that slowly anyway, most probably. But they do have another issue, which is kind of, I know, on the minds of the people in China too. They are fast approaching a demographic precipice. And it's said that, and these are rough numbers, don't quote me on these, but between 2020 and 2050, they will lose 200 million working age adults. So they better get those bots from Tesla soon. And that is a population the size of Nigeria, by the way. That is a big country. And they will gain 200 million senior citizens. So not only are they losing workers, but they have to support the same amount of old people. And they're not having babies, which has been a concern that Elon Musk has been very worried about for a long time. Great question. So we believe it's highly, highly unlikely. It was one of my 2022 predictions that I thought Ukraine would happen and maybe something would happen to Taiwan. But now, after seeing the reaction to what happened in Ukraine with sanctions and everything else, I think the Chinese are going to be far more conservative, and they got bigger issues, we believe. So next question is from Euroclock. Do you use or recommend budgeting software to keep tabs on your financials, e.g. YNAB, Quicken, Personal Capital, etc.? There's Mint and a few others. So in the past, I did use Personal Capital years ago. I don't know, 5 or 10 years ago. I can't remember. But once you sign up, they never stop calling you. And I don't like that. So I'm also always very paranoid, and I've said this many times before as well, about having financial data online. So I like to keep it off. I like to use spreadsheets, but I do use Quicken and QuickBooks for a lot of day-to-day management of items, and I use both for different purposes. But just be very careful what you put online. If it's just for your typical expense management and stuff, of course, it's completely fine. But there's nothing wrong with a good old spreadsheet as well. Next question. This is a fun question from Maverick06. Can you rank the 5 Tool albums in order that you enjoy the most? Wow. It's taking me back in time. So I first heard Tool. It was in Zurich, Switzerland in about 1991, 92. That's more than 30 years ago. And I used to like hard rock, grew up with like Metallica and stuff like that, you know, being a kid. But that was super, super interesting. So in terms of my top 5, here they are. So they are not ranked in order, but number 1 is Fear Inoculum. Number 2, 10,000 Days. Number 3, Laterals. Number 4, Enema. And number 5 is Undertow. And an honorable mention as well, Maynard James Keenan's other projects. One of them is A Perfect Circle. There's an album called 13 Step, which I think is also very brilliant. Just throwing that in there. And again, this is hard rock music, ladies and gentlemen. So proceed with caution, not music advice. Next, big thank you as well to the donations. We have a new little baby, Tavita. She is a 14-year-old elephant rescued at 7 months in Kenya and very trusting and very friendly. So thank you all. Let's jump into some questions and turn that off and hope everybody's doing good. I know it's a difficult market condition. You've heard me talk about that for over a week now. So one Brightum, what is the best way to make short-term money consistently? Free from my 9 to 5. What is the best strategy for this and the best way to learn? So what I did back in the 90s, I used to do some day trading, scalping, but it just took up a lot of time because I was also working full time. So I tried as best I could, but what I found to be very effective is covered calls. Find a good asset that is kind of a range rider and just sell calls at it every 6 to 12 weeks. Cover calls do that, generate 10, 15, 20%. If it's on margin, you can get really good returns. Find your rhythm, do it like clockwork. I did that for a long time. And even it helps hedge your downside, caps your upside if it is a hyperbolic stock like a Tesla or something, but just find ones that are really good, that pay really good premiums, that are volatile but stuck in a range. And that's what I did to great effect. And every time I made money in the stock market, I parked in real estate to buy rental units. Wash, rinse, repeat. Wash, rinse, repeat. It takes 10 years to build up a substantial amount, but it all depends what you start with. Now it's hard right now, but that's what I'd recommend. But also be careful, because once we go risk on, the markets will rebound really fast. That's what they do. They fall really fast, but they also rebound really fast. So sometimes imagine you buy, so a simple example, Tesla is trading at $650, call it $600. If the market tanks next week, we might be able to snag some Tesla at $600. It's doing a 3-for-1 stock split. If you sell a call capping your upside at, say, a $210 strike, Tesla could easily go to $400. You don't want to do that in those types of stocks. They're the ones you want to hold and keep, especially at these low prices. BreakBeatStu, just a thank you, Bell. Thank you, buddy. Hang in there. Hope everybody's good. Crypto Skeeter, can you please explain exactly why there's a discrepancy between ETH and staked ETH? Okay, that's a good question. So what staked ETH is, it is ETH that's locked up, waiting for the proof of stake merge. That's why they call it staked. Not only is it staked, but it's waiting for proof of stake. So that's I think that's why they came up with the name. But basically, those people that want liquidity, they can borrow against it, and that's the problem. So it's a waiting game. That's why I believe there'll be no death spiral of staked ETH. It's a pretty safe asset, and if it gets down around like 0.9, etc., I think it'll bounce very nicely. Let's check exactly where it is right now, where the peg is at. I do watch it a lot. Boop, boop, boop. Hang on a second. It is important to monitor, and I should have it in. Yeah, it is there. So staked ETH is 0.935. It's been hanging around that same level since yesterday. So once it starts going down lower, people will arb it. So I don't think there's much downside beyond 0.90, unless, of course, a huge amount of staked ETH is dumped at the same time. Then the market is not big enough to absorb it all. So that is the discrepancy. It's basically a time game. Those people that need liquidity now are willing to use this vehicle to get it. Shelley H, could Celsius pay users out in staked ETH or wrapped Bitcoin? Technically, yes, they could. They can pay people out in anything they want. So that's a simple question. And there's a lot of talk. I think Simon Dixon from the UK is getting involved, and he's also apparently a shareholder to Celsius. He has a lot of Bitcoin tied up on Celsius, and he's trying to present some solutions as well to make Celsians whole again, or as close to whole as possible. So fingers crossed, there are good people advising them. Bob, this is from Bob, could you put together a fiat compendium? I'd love to see how the different world currencies compare to each other. That's a very good idea. Just comparing money printing and backing into inflation rates. I actually created a model that estimates the amount of inflation based on the amount of money printing. So that would be fun. But right now, the interesting thing is, or if it's not interesting, but the US dollar is actually one of the best fiat currencies on earth. And it's a piece of crap. So you can imagine how bad the scores will be for all the others. And that falls into that category of things like the Japanese yen. I think the best managed currency is the Swiss franc, because they're not given to a lot of money printing and inflation, and they got very, very strict fiscal management. Bill Whammers, thank you so much, Bill. Hope all is well in Switzerland. Clint Downing, for the animals, thanks for all you do. Appreciate you guys. No questions today, but thank you all for being here. Why do you think there is not a coordinated attack to push Bitcoin price down on the Celsius liquidation price? I think there is, but the people that want to attack it don't have that type of heft to be able to push it down that low. So my calculation is, I have my 21 multiplier to actually increase price. If somebody goes and buys $1 billion, it increases the market cap of Bitcoin by 21 billion. Well, the corollary is also true. So to take Bitcoin down, the market cap, call it 600 billion right now, to reduce it down to basically 13,000, it needs a 33% haircut. So you need to dump a truckload of Bitcoin to make that happen. And back of the numbers, you need somebody needs to dump at least 60 billion of Bitcoin to take the price down to 13,000. Just rough in my head calculation. And who's got that 60 billion? I don't know. And also, I was actually watching buy walls and sell walls yesterday, and some of the transactions that were happening over the last 24 hours. It's super interesting. It'll be hard. Typically, there's this weird phenomenon as well where markets do a bottom. Yesterday, we saw a vicious bottom on Bitcoin. I think it shot down to, let me get the exact number. It was a 17.4. I was watching it as finger on 17.592. Now, if Bitcoin goes near that double bottom again, people will be ready, because people actually set their limit orders now based on this new recent bottom, and that's where they buy. So the sell pressure to smash it through that 17.6 again will be very hard. And right now, price is 20,250. So since yesterday, just to show you how volatile this beast is, it's gone up 15% in 21 hours. 22 hours, sorry. So, great one. And a big thank you as well for your donations. Jabba, appreciate you. Dog1, MT, Jeff Hammer, as always. AC, Neat, and Sleepless. Everybody hang tight. This is a rough time in the market. But if you have the patience just to zoom out and wait, we'll get to the other side. 3 months from now, 6 months from now, things will be a lot better. Okay, thanks all. Happy Sunday. Happy Father's Day as well to all the fathers out there. Take care of yourselves and go spoil yourselves rotten. See you later.